Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We've just released our monthly India Market Outlook titled Attractive Income Opportunity. In today's podcast, we will discuss the key implications of the RBI's latest policy review and fiscal year 2024 Union Budget for bond investors. As we enter 2023, bond investors have experienced 2 years of muted returns in their bond allocations. In 2021, it was the loose monetary policy and low interest rates that resulted in muted returns in the bond portfolios, and in 2022, normalization of loose monetary policy and aggressive policy rate hikes to curb inflation further resulted in lower returns in bonds. Now, coming back to the two important events in February, the latest was the RBI monetary policy. In its February policy, the RBI raised the repo rate by 25 basis points to 6.5%, which is a 4-year high, and maintained its withdrawal of accommodation policy stance. The RBI revised up its fiscal year 2023 GDP growth projection to 7% from 6.8% earlier, and pegged its fiscal year 2024 projections for growth at 6.4%. On inflation, the RBI revised its fiscal year 2023 average inflation projection down to 6.5% from 6.7% earlier, and pegged its fiscal year 2024 average inflation projections at 5.3%. In our view, the policy rate hike was in line with market expectations. However, the RBI maintaining its withdrawal of accommodation policy stance, given still elevated inflationary pressures, was hawkish compared to market expectations. The second important event was the Union Budget for fiscal year 2024 at the start of February. The government took steps to spur growth with high capital expenditure, boost to manufacturing, and a cut in personal income taxes while maintaining fiscal prudence. The government set fiscal year 2024 budget deficit at 5.9% of GDP compared to 6.4% of GDP for fiscal year 2023. The government's net government borrowing requirements for fiscal year 2024 is expected at about INR 11.8 trillion. Now, both fiscal deficit and the government financing requirement was in line with market expectations. However, the bond markets cheered the shift in the quality of spending towards capex and cuts in subsidies towards pre-pandemic levels. Given this backdrop, in our view, bonds offer an attractive income opportunity at current levels, as bond yields are close to their peak levels for the following reasons. 1. The budget is unlikely to be inflationary given fiscal consolidation and, more importantly, improvement in the quality of spend. Second, receding inflationary pressures over the past few months is likely to provide RBI the room to pause further rate hikes. Third, modest supply pressures given a small increase in government borrowing plan for fiscal year 2024. And fourth, the RBI is likely close to the end of its rate cycle, with swap markets pricing in another 25 basis points rate hike by the RBI over the coming 12 months. That's it in this edition. Do reach out to your relationship manager for a copy of India Market Outlook. Thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.